basically of the 150-year plus gap like we've had between like that we've had this period where transaction speeds and settlement speeds are so different. That's a big part of what I focus on in the book is that ever since the invention and specifically the deployment, widespread deployment of the telegraph and kind of ushered in the telecommunications era, there's no fast way to send long distance value without credit. And so we just basically had more and more credit, more and more abstraction until we just kind of like lifted off from gold and kind of left it behind. But the downside of that gets to the how, like what's actually broken is that when you look around, there's 160 plus different currencies. Each one's like a little currency bubble, and they're all devaluing at different speeds. So some of the most robust ones grow at 6 or 7 or 8% money supply growth a year. Many of the developing country currencies grow at 15, 20%, 25%, in some cases more per year. And people are just kind of constantly getting diluted. And so they're constantly on a treadmill where you have to constantly try to earn higher wages. You have to constantly figure out what you're going to do with your savings. You can't just save it. You have to invest it. And so that's like a treadmill that everyone's on at different speeds. Cross-border payments, despite the fact that we live in the telecommunication age, are not as efficient as we probably expect them to be. If people 50 years ago saw that the money system still, in many cases, works the same way it used to, with just a little bit more fintech overlay, I think they'd be surprised at how kind of little we've developed here. But the main issue is just the fact that the way it works is that it's become so centralized and people are stuck in these 160 different currency bubbles.
SEC's Gensler speculated to amass Bitcoin ETF applications for potential rejection. Gary Gensler, the chair of the U.S. Securities and Exchange Commission, SEC, since 2021 is speculated by experts to be accumulating Bitcoin exchange-traded fund ETF applications with a potential intent of collective rejection. This move could lead to widespread lawsuits and significantly impact the cryptocurrency sector. Gensler's controversial stance on Bitcoin ETFs has been a critique of the SEC's inconsistent approach towards these financial instruments. Under Gensler's leadership, the SEC has consistently prioritized investor safety, rejecting multiple Bitcoin ETF applications. Despite a legal victory for Grayscale in June 2022, where the court ruled in their favor against the SEC following their refusal to convert its Bitcoin trust into an ETF, the regulatory body has only approved futures ETFs for Bitcoin and Ether. The SEC maintains that these offer more robust protection against potential market misconduct. Bitcoin finally enters bullish phase based on this indicator. The Bitcoin monthly MACD, moving average convergence divergence, has crossed the zero line, signaling a potential entry into a bullish phase, according to recent analysis by prominent cryptocurrency trader Dave the Wave. This movement has grabbed the attention of investors, enthusiasts, and analysts as the world's premier cryptocurrency. Bitcoin stands at the cusp of a potential price rally. A reliable indicator of price moves, the MACD is a trend-following momentum indicator that showcases the relationship between two moving averages of an asset's price, typically the 12-day and 26-day exponential moving averages. When an MACD moves above the zero line, it is generally interpreted as a bullish sign, suggesting that the asset's price might see an upward trajectory in the near future. The recent chart depicts that Bitcoin's MACD has now shifted above this crucial threshold. Such a move has historically preceded price rallies and is viewed as a positive sign by many technical analysts. Recent bullish predictions recently, global asset management firm Bernstein expressed confidence in Bitcoin's potential price performance, projecting a surge to $150,000 by mid-2025. Given Bitcoin's current trading price of $34,400, this would require an impressive 336% rise from its current position. The projection is grounded in the historical relationship between Bitcoin's price and its price to marginal cost. Past data suggests that Bitcoin's price seldom falls beneath its marginal costs, implying this metric could serve as a supportive floor for the cryptocurrency's value. In other optimistic forecasts, crypto services provider Matrixport posited that Bitcoin could ascend to a range of $42,000 to $56,000 if BlackRock's ETF gets the green light. This prediction hinges on potential capital inflows nearing $24 billion. Furthermore, banking giant Standard Chartered revised its end 2024 forecast for Bitcoin to $120,000, up from its earlier prediction of $100,000, highlighting increasing confidence in the crypto market's resilience and potential. Let's continue our discussion with Lyn Alden.
The world will look different. It's always hard to predict the future, but in general, investing would be more optional. So right now, it's like a necessity. Like, for example, no matter where you are, like I know people in Egypt, and but as soon as they get money, you plow it into like real estate or something. You don't just hold the money because it's like holding melting ice cubes. And of course, in the United States, we plow it into the S&P 500 and other similar things. And so in that world, saving becomes more of just a normal thing, and investing is more of a niche thing, an optional thing, something you can do. And this particularly impacts people in the working class and middle class. In many countries, for example, people are literally just saving cash. They're not even getting the interest because bank accounts have overhead costs, and so if you have a net worth of like $500, they often just don't even try to go for that market. It's not something they care about. The costs start to overweigh any sort of like usefulness they get from that. And so many countries still have underbanked people. But in that world, saving just makes more sense. Saving just works better. And also the contracts that people do in society shift a little bit more to favoring the status quo. So whenever you have a contract negotiation, whatever the current contract is kind of like the default starting point, and the entity that wants to change it, the onus is on them. And so in a world where there's inflation every year, anyone who's trying to get higher wages or raise their rent for their tenants or raise their prices as a small business or something, it's always on you trying to make that action. And that's particularly hard for wage earners because there's an anchoring bias because of that status quo. So if someone comes to you and says, I want a 5, 6, 7% raise, you think, why are you 5, 6, 7% better than last year? But really they're not. It's just the money supply was so diluted. But realistically, they're going to get, 3%, 4% increases. And so they're going to slowly kind of get eroded compared to the rate that money supply is growing up, house prices are going up, and things like that. A lot of people change jobs unnecessarily just because that's actually a way to kind of restart the anchoring bias and get the wage that they can't get at their initial employer, which is inefficient. But in that world of sound money, the existing status quo have a stronger negotiating position. Even if your salary is not changing, if your money is hard and productivity is increasing, you're getting a small real wage increase every year. If you're getting 1 or 2% increases on a sound money, you're doing well. And if there's so much deflation, the employer wants to reduce your wages. Well, that's going to be tricky for them to do. They could try, maybe if it's, it could happen, but it's unlikely. Basically, it just starts favoring the productive class rather than the arbitrage class. And I think that's good for society. I think a side of an unhealthy system is when engineers go work in Wall Street and can make more money there, rather than go work building products. And yet that's what we see a lot, is that the best place to make money relative to your training really is Wall Street. Like people with a bachelor's degree can just make an enormous amount of money because that's the source of arbitrage. And I think that gets greatly minimized in that other world. Yeah, I think the high conviction view is that overall saving just becomes more important and investing becomes that more niche optional thing you can do, less necessity. But the lower conviction thing is what would those investments look like? Like, what would people be more diversified or less diversified in that world? I don't really know. Certainly people that are trying to build wealth quickly would want to probably be more concentrated. That's, you're trying to outperform. Overall investment selection would still be similar. But it's just like, that's something that professionals do. It's something that if you have spare capital, it's something you can go into. But it's just not this necessity. So the overall importance of that in society gets just downgraded. It becomes more kind of utilitarian. And another key factor is that right now, if you have a lot of assets, you can get access to cheap credit because you can use those assets as collateral. Obviously credit's a little more expensive today than it was a couple of years ago, but on average in society, you can get a much cheaper credit than someone who has no assets, which of course is going to be true in any system, no matter if it's hard money or soft money. But when you have soft money, when the unit of account itself is always shrinking, it boosts the importance of having that cheaper credit because all the wealthy people that have assets and that have purposely some degree of liability attached to it, could be mortgages, could be other things. You're basically shorting. It's like an extra source of wealth creation. You're shorting society's devaluing unit of account. And that's like one of your long-term kind of sources of wealth creation that the kind of working class and below is kind of locked out of. But in a world of sound money, debts are more strategic with their purpose. There's no reason to have like a...
If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.